So welcome out. Let's dive into the topic here tonight. If this is one of your first weeks on, I'm Shade Ferre. Stephen Swenson and I conduct the webinars every week. We are always focused on tax sales, but we're often looking at tax deeds, property acquisition, and that's only a part of what tax sales are really all about. Tax sales offer a pretty wide variety of opportunities, and we want to talk about one aspect of tax sales, which is tax lien investing, and specifically what some of the tips are, or you could say secrets of investing in tax liens, different things you can do to simplify the process, things that we've picked up over time. Now, some of these are almost more like common sense, or I wouldn't necessarily say that they're secrets, but that sounds good. It gives me a theme to base the presentation on. Couple of things here. Questions. We'd love to get questions, so feel free to ask questions at any point. During the event, we can always jump into questions if it's relevant. We can wait towards the end. I mean, basically, you're free to ask the questions whenever, because it's up to us to determine the best time to answer and the best way to make the webinar go smoothly. So feel free to ask at any point. Questions only help things. We always record the webinars. We'll have that available. Hotline. The hotline is available for everybody. I mean, if you're on the line right now, then you qualify to have hotline support and service. So feel free to use the hotline if you have any questions, or if you're even just to a point where you're not sure what to do. If you're just trying to figure out what to do next, the hotline is a great place to call. Part of what we're here to do is not just give you specific answers on things, but it's also to be a bit of a cheerleader. It's to help you see the benefit and advantages of things, especially if you're not sure what to do or if you're getting discouraged. So, make sure you use us, for that reason. And, it's a good time right now to, if you haven't bought anything, it's a good time to get involved. And the last thing there, personal coaching. We've started to take on personal coaching students, and to give you an idea of what we're doing, we're calling it the A-team. What we're really after, though, is this. We're working with a small group of people, and our objective is to try to work with highly motivated people that we can help to achieve something within a short period of time here. In other words, we want these people to achieve extraordinary levels of success so that we can use it for a marketing campaign that we're getting ready right now. So we figured the best way to do that is to just show people if we have students that are out there buying things, which we have students that are buying things all the time, we just want to document that. And so our personal training students we're working with are doing that now. If you are interested in that, hit us up. There's limited openings, but we still have a couple left. Okay. So let's just go ahead and dive into this. Now, some of this, I guess if we were to start off here with tax lien fundamental, let's just talk about the definition of a lien, because I think you've got to understand a couple of things that are fundamental in order to really understand all of it. And the better you understand some of these fundamentals, the easier it is to go from state to state. So if we're talking about exactly what a lien is, a lien is sort of at the heart of all tax sales. Even some tax deed states still use liens, even if they don't sell them to the public. So liens are just a natural part of tax sales. But what exactly is a lien? Well, a lien is a form of security interest that's granted over an item or a piece of property. And the purpose of that, or the idea, is to secure some kind of a payment, or to use that item as security for a debt. So if there's money that's owed, a lien is basically the party's ability to take possession of an item or to use that item as security. So in the case of a tax lien, we're talking about property, a home, and the county's ability to put a lien against it is the ability to use that home as security for an amount that's, for some kind of a debt, and that would be the debt that's owed in delinquent taxes. So a couple of things about liens to remember. they prevent the transfer of ownership. So if there's a lien placed against a property, it can't be sold until the lien's taken care of. And eventually, liens can be used to foreclose on properties. Okay, now that's after a redemption period has occurred. So those are a couple of fundamental things here about tax liens, but I'm sure we'll dive in and out of different aspects of it as we go through some of these questions. So let's talk about 10 different secrets of tax lien investing, or 10 different tips, you could say. First off, this is probably one that we've battled with, I would say, more than anything else. And that is just trying to get people with the right mindset and the right, I guess we want people to think about tax liens the right way. And part of the reason why they don't think about tax liens the right way is because salespeople have always been using the term tax lien whenever they're talking about anything real estate and tax sale related. But tax liens are just one aspect of it. If you're investing into tax liens, make sure that you understand and know going into this, you're investing into tax liens to earn a high interest rate return. That's your objective. That's going into a tax lien. That has to be your objective. If your objective is anything else other than that, you're probably going to run into some problems because there are many aspects of it that are just outside of your control. The other thing here with this first tip here is that it's a long-term investment. You can't control when a lien redeems. A lien redeems essentially when a property owner pays off their taxes, and you don't know when that's going to happen. It can happen at any time. It can happen before, I guess it can happen before the redemption period comes to an end. It can happen after the redemption period comes to an end. So in that case, you really have to plan for the maximum duration. That's the only way to really invest in tax liens. And so tax liens have the potential to redeem within a year, but you have to plan on the worst case scenario. So if it's a 3-year redemption period, then plan on a little more than 3 years. If it's a 2-year redemption period, then plan on maybe 2.5 years. If you're planning like that when you're buying these liens, then you're never going to end up in a situation where you're investing money that you need. And I think the idea with that is to recognize the fact that when you invest in tax liens, it could take a while for you to get your money back. But if you're investing long term for a high interest rate return, that's kind of what you want anyway. In other words, the longer that lien is earning interest for you, the longer it is between when you have to reinvest the funds again. So if it's earning a high interest rate return, you want it to earn that as long as it can. So that's kind of the first thing, and that's really almost more about mindset than anything. But it's also one that people get wrong right off the bat so oftentimes because they start looking at tax liens and they start thinking property. The idea behind tax liens is that they're used to enforce property tax collection, but the vast majority of them redeem. That's how the system is supposed to work. Most liens end up redeeming. The ones that don't end up being foreclosed on, but the vast majority redeem. So keep that in mind too as you're looking at liens and as you're making plans. The fact that the majority of them redeem really plays into what we're talking about here. Okay. Now, the second one here, tax liens are only going to have 2 possible outcomes. And I think one of the important things is not to overthink it. Tax liens, really, the outcome is completely dependent upon when the property owner pays and when that occurs, or I guess if and when that occurs. So when you're looking at a tax lien, the most likely case is going to be redemption. But the due diligence you're doing is just in case you were to need to foreclose. In fact, the majority of the time, the due diligence that you'll do on tax liens won't even really be helpful, or it won't even really matter. When a lien redeems, the due diligence, I guess, doesn't really matter. The only time the due diligence becomes a factor is if you need to foreclose on the property, and then you'll be glad that you did. So, a couple of things here. We know that tax liens stop you from selling the property once lien's placed against it. Every lien has a redemption period. That is just a given. Whenever there is a lien that is issued against a property, they also issue a redemption period with that. So you can guarantee that redemption period will be determined by state law, And aside from it being set by state law, when a tax, I guess when a lien is placed against a property and a property is facing potential foreclosure, so let's say that a lien is placed against a property and the redemption period expires, what you're looking at in that case is a judicial foreclosure. It is a foreclosure that's going through the courts. It's a foreclosure that's done by state law, and therefore it extinguishes most claims or ownership rights that would be to the property. So I guess to think about this, it's going to wipe out most anything that the foreclosure of the property would wipe out most anything that would be attached to the property in terms of some type of encumbrance or lien. I mean, the whole idea behind foreclosure is to remove property owners' rights to the property. And for the most part, that's what foreclosure does. Let's get down to some of these interesting ones here. Okay. Now, this is another factor. I think oftentimes when we're looking at tax lien investing, we have a tendency to look at every state and try to figure out where we want to begin. I think you're trying to determine where there's sales taking place, and you tend to spread yourself kind of thin. The best way to have success with this and the best way to operate is to choose a specific state. And that state needs to have a maximum interest rate return that's acceptable to you. So, in other words, the whole purpose in investing in tax liens is to earn a high interest rate return. So what exactly is, the rate of return that you're after? And that would determine which states you would invest in. Because there are a lot of states that might have an interest rate of 12%, annually. But then as the interest rate goes up, you end up with fewer and fewer states until we've got just a handful of states that offer, the highest interest rate returns. So if we're looking at all the states here in the country, what states are going to offer the best opportunities? Well, in terms of just flat interest rate returns, here's how it breaks down for the highest interest rate paid out by different states here. These are the states that have the highest interest rate. Now, another point here is that not all interest rates are created equal. And that's because some states have, there are several different ways that states can decide to pay out interest, and they typically have it set up in state law, so you can read about it. But for some states, they have an interest rate that accrues on a month-to-month basis, and they have that maximum percent set. So, for instance, 18% would be 1.5% per month. But there are other states that change the interest rate return that you earn based on how long it takes the property to redeem. So, for properties that redeem within the first 6 months, they pay out this amount. If they redeem over a longer period of time, they pay out this amount. Other states do it according to the amount of the lien. So maybe for liens under $5,000, they pay out this much, and for liens over a certain price, there are so many different ways that you can get involved. That's part of the reason why it's important to pick one state and really from there to even zero in on some specific sales. But the reason why you want to stick with one state is because part of the reason why tax sales are confusing is because you've got 50 different states out there, and every state's got its own set of laws. And just digging into and learning the laws for one state is enough for most people. But to try to learn it for all the states is, it's more than most investors can take on unless you've got a long time to do it. So what you really want to do here in the beginning is find a state that has an interest rate return that's acceptable to you. Okay, so if you look at it and say, okay, if I'm going to buy tax liens, I want to earn the highest interest rate I can. If you're after interest rates ranging from, what are the possible rates? 10 to 25% typically, 10 to 24%. That's about the range that you're looking at. And beyond that, you have to think about the method that you're going to be using to buy them. because that can also change the overall rate of return that you're earning. Now, the other factor that comes into play here are penalty rates. Penalty rates that some states add in. And penalty rates can change the tax lien investment dramatically. So it's important, I think, to understand how these penalty rates work and to choose accordingly. For instance, Florida probably has the easiest penalty rate to explain, just because they pay out 18% max. So if the auction is competitive by bidding down the interest rate, then you could certainly earn less than that if you're competing against somebody in bidding. But 18% is what the state law sets as the maximum. Now, in addition to that, they've got the 5% early payoff penalty, meaning that they'll automatically add a 5% return on top of whatever you're going to earn percentage-wise to any lien that redeems within the first year. So that 5%, that flat 5%, has the capacity to dramatically change what the overall returns are. There are some other states that also offer penalty rates. Maryland has kind of a penalty rate system. Maryland offers a high interest rate return, but it's a little bit different system. New Jersey also has penalty rates that it offers. New Jersey also has an 18% return. In fact, New Jersey has some pretty good laws for tax lien investors. However, in the past, a lot of New Jersey's sales, a lot of the municipalities or counties in New Jersey that would hold sales would put everything into big batches and sell it off to a single investor or to some investment group, so they didn't have to have a sale. They would basically sell everything off to one company, and there are still some locations that do that, but I think that was because they were limited as to how much success they could have when they're holding live auctions. When they're holding live auctions, they're limited by who they can drag out to the sale. With online auctions now, that's changing. In fact, I would say that over the last 5 years, we've seen a pretty significant drop in the number of institutional bidders that you're going to be competing against. It used to be the institutional bidders were the majority of the competition at a lot of these big sales, but it's not really the case anymore now that things are online. Okay, the next tip here, the next secret, only purchased first-year liens. Now, that is a pretty good rule to go by. Why only purchase first-year liens? There are a couple of different reasons for it. First off, a first-year lien, when we're talking about a first-year lien, we're talking about the first year that the taxes are delinquent and that a lien has been placed against the property. When that happens, you're going to have a lower lien amount compared to the property value because you've got 1 year of delinquent taxes that are owed. So taxes, penalties, and fees, but it's just still a single year's worth. If you buy a tax lien as a first-year lien, there are a couple of different advantages that you're going to be working with. The first is that if the property doesn't redeem, you're going to have first foreclosure rights on it, meaning that there's no other tax sale investors, that you'll be competing with to foreclose on the property. If you buy that first-year lien, you're going to have the first chance to foreclose on it. Now, another reason why it's a good idea to buy first-year liens is this. Some tax sales can be competitive. In fact, if you've participated in a live sale before, maybe where they bid down the interest rate, then maybe you've experienced that before. In some cases, there may be a lot of competition, but when you buy a first-year lien, the majority of first-year liens end up turning into second-year liens too. In other words, once there's a lien placed against a property, the majority of the time they don't pay off within the first year. There's oftentimes a second lien that'll be issued against the property. When the second lien is issued against the property, the county will contact you and offer you the chance to buy it. Now, when they offer to do that, you'll make the maximum interest rate return on that for the second year. So regardless of what you earned in the first year, if if you have that first year lien, you automatically can get the chance to purchase the second year lien and earn the full or maximum interest rate return. So that's going to simplify things for you dramatically when it comes to investing and to making money. And that's because you don't have to do any additional homework on the property. You've already done your homework on the property. You don't even have to attend a sale. The county will usually contact you beforehand and just let you buy it. So, I just realized.
Buying that first year lien is going to save you a lot of time. I mean, let's say that you purchase 10 tax lien certificates at the auction. The next year you have the opportunity to purchase, 5 of them for the second year lien. Well, in that type of scenario, you're going to be making, the interest rate that you bidded on the first lien, and the second lien you're going to make that maximum guaranteed return. And also, when the end of the redemption period is over, if the property does need to be foreclosed on, or you're going to foreclose on it, you'll have already paid those property taxes, so there's not going to be as much of expense as far as the foreclosure process.
Yeah.
And so if you ever have a chance to pick up the second year lien, we always recommend doing that.
Yeah, in fact, and what Steve means is let's say that there is a 3-year redemption period on a property. If it has a 3-year redemption period, if you wanted to foreclose on that property, so let's say you bought the first year lien and your redemption period came to an end, just like we mentioned before with tax liens, they prevent the transfer of ownership until the lien has been removed from the property. And that applies to this situation where you'd like to foreclose on the property. In order to foreclose on that property and actually transfer the ownership, so before they'll actually transfer it over to you, one of the requirements are that the taxes are current. And so in order to bring taxes current, it means you have to pay off anything that's past due. And if you already purchased the second year lien, then you've already paid for that portion of property taxes. If they were to offer you a third year lien, you could buy that, and you would essentially have already paid all of the property taxes because you bought every lien. If you decided to pass up and not buy it, then the requirement would be that the taxes were current. So if somebody else had bought that lien, when you paid off the taxes that were owed to foreclose on the property, the other lien would be paid off as well at the same time. So it's always a good idea, I think, to buy those the second year liens because jump on top of the opportunity to pick up a second year lien if you're offered it from the county, because you're going to earn that maximum interest rate return, and you won't have to worry about it at the end.
It's also going to increase that first interest rate return. For example, let's say you went to Florida and you won a tax lien for 15%, and the next year won 18%. Well, that'll probably even you out to maybe a 16 or 17% return versus a 16% for that second year lien.
Oh, let's see here. I'm just looking at over. That is interesting. So one of the questions that we have from the student, she's saying, I purchased a county-held tax lien on July 1st. Now, county-held is another way of saying over-the-counter. Okay, so I purchased an over-the-counter tax lien on July 1st from Duval County that they direct deposited my payment in my checking account September 3rd. So it means that the tax lien, so essentially about 2 months. However, the amount deposited was only the amount I paid for the lien without any interest or early penalty fee. I checked the tax record and I see that the owner paid the lien on July 15th. Let's see, why did I not receive the early penalty fee? That's an interesting case.
You should have. I would probably contact the county unless the only thing I can think of is that the property owner redeemed, or the tax lien may have been redeemed. But if it was redeemed, may have been redeemed before they bought it, or right when they bought it. But even then, That doesn't make a lot of sense.
The only thing that I can think of that it could be because of is maybe because of a foreclosure. Like, I mean, not a foreclosure, but a bankruptcy, something like that. Um,
I would
if
contact the county either way, though, because
yeah,
it might just be a simple mistake.
yeah, and that's true. If a bankruptcy is filed on a property that has a tax lien placed against it, um, and that's probably like worst case scenario is the bankruptcies filed against the tax lien. They return your money to you essentially, but you don't earn the interest rate return. Uh, if I guess depending on when the bankruptcy was filed. If in some cases they would just have the lien stop accruing interest if it had already accrued interest up to a certain amount. But with that being a pretty short investment, I don't know. I mean, because granted that what that should have paid out to you, with it being about a 2-month investment, is and it being an over the counter lien in Florida. With it being an over the counter lien, it should have paid out 18%. And so for 2 months, you'd be looking at roughly 3% plus a 5% early payout penalty. It should have had an 8% return on it. That is bizarre. Okay, so another question is, if you bought the first year lien, this one's from James. If you bought the first year lien and the tax is due again, would you have to look for that property again to buy it again? And no. In fact, in most cases, I guess think about this from the county's perspective. This whole thing is a system that works and that the county needs to work. The county needs tax sale investors to come in to buy their liens and deeds. Otherwise, they'd be in a lot of trouble. So when they have somebody that buys a first year lien, they make the assumption that you might be interested in buying the second year lien because they understand the system and that if you want to foreclose on the property, you'd have to have the second year lien anyway. If it were to come to that, they also realize you're going to make maximum interest rates. So a lot of investors decide to do that. The county will most likely contact you or send you information. So that'll sometimes come in the form of a letter in the mail, or sometimes they'll actually just pick up the phone and call you if they have a phone number for you. But then they'll give you an opportunity, and typically that takes place maybe a month before the sale, maybe a few weeks before the sale. It's usually right before, and they do that so they can determine whether or not to include it in the sale. So they're going to give you the first right to refuse it, essentially. So you shouldn't have to really look for it. It should just be a matter of the county contact you saying, you have this lien, would you like to buy this one too? Because they're
One thing you'll want to do, though, just to be on the safe side, most counties will contact you, but in case they don't, if it gets around the time of the sale, contact the county to find out. Just in case, I mean, most counties do, and generally most of the students that we've worked with and ourselves, the county has either sent an email or some type of letter letting you know that the taxes are available and that you can purchase it. But if you have a tax lien that's owed and you haven't heard from the county, just give them a quick call or send them an email and find out, just so that you're on top of it.
Yeah, it simplifies things for the county to be able to sell it to the same person. And so yeah, it's definitely worth calling them and try to set it up. Okay, some other things here. Okay, now you want to select liens that have a bid to value ratio of 7% or less. Now the 7% number was a number I had a hard time putting up an exact number because the truth is that number varies depending on the county. Some counties are more expensive to live in than others. Counties have different property tax rates. So in some cases, you'll have properties and liens against them, and the liens are maybe the liens might have a bid to value ratio or a lien to value ratio of 2 or 3%. But in other cases, that lien to value ratio might be higher. In counties that have higher property taxes. So it's hard to set an exact number on what that is. What you should note is this: when you're looking at properties on a tax lien list, they'll generally have they should have roughly the same bid to value ratio, roughly. Maybe within 5 or 10%. Unless there's something weird going on with the property. And that's really what we're trying to identify here is if you come across a property, a tax lien that has a bid to value ratio that's much higher than that. And what you might be looking at is some type of an issue. It might be a way to identify a potential problem. The types of problems that you could be looking at, if a county doesn't sell a lien 1 year, they'll put that on the books. You can buy that over the counter. But if they have another sale, oftentimes counties will just add the amount of the taxes that were owed onto the existing lien rather than creating a whole new lien. So normally when you look at liens, you're going with the presumption that you're looking at a single year's worth of taxes and fees, but that's not always the case. They could have multiple years worth of taxes, in that lien, and
that's especially going to apply to certain over-the-counter type of tax liens.
Yeah. Yeah, if you're looking and it's got a crazy bid to value ratio. I mean, if you see a bid to value, sometimes you see bid to value ratios even for liens that are like 50% or 80% or
yeah, if you see $1,000 building lot and it has $500 tax lien on it, in the middle of Arizona with nothing but sagebrush and rattlesnakes, it's not a tax lien you want to invest in. But if you see a tax lien that's $2,000 on a $100,000 single family home, well, that's a tax lien that we're going to look at because it has a good bid to value ratio. Maybe it's between 2 to 3%.
Another thing to keep in mind is that when you're increasing that bid to value ratio, well, I guess if you're looking at two different properties and one has a bid to value ratio, I guess what I'm trying to say here is essentially that bid to value ratio is your security. And the higher that goes, the more your security drops. Now, luckily with tax liens, you've got a really big cushion of security there, because we're talking about not buying anything with a bid to value ratio higher than 7%, meaning that what you're actually paying should have very little value compared to the overall value of the property. You should have a tremendous level of security, and the lower that number is, the better your overall security is. So if you do see liens, that have a bid to value ratio that is high. I mean, in some cases, 7% for some counties might be high. If everything else they have is 3%. But I think as you start to work through lists and you start to pay attention to bid to value ratios, if you see something that it seems like it's higher than the rest, it's always a sign that maybe there's something wrong with the property. Maybe you're looking at multiple years worth of taxes. It's a good indicator. It's a good indicator of what's going on with the property. Next, over-the-counter liens, guaranteed interest rate returns. Which is again bizarre with the last case here with the student, where over a couple months there she didn't get a return.
And talking about that interest rate return, it just kind of reminds me of a story I was reading today, or an article just about how many hedge fund managers are taking a lot of, betting against the stock market that it's going to drop, and invested literally millions and millions of dollars over the last couple of weeks. And when you look at the stock investment, sure, there's a chance to make money, but there's also a chance to lose a lot of money. With tax lien certificates, you're looking at that high interest rate return, higher than you're going to get at a bank, higher than you're going to get pretty much anywhere. It can range anywhere from 10 to 24%, and it's guaranteed by the real estate.
Yeah. Well, if you think about it, even for, well, in a lot of these states, 18% is a rate that you're going to have a hard time finding much anywhere else. And it states right there that, these pay out 18%. I mean, it's just a flat rate when you're looking at a lot of the over-the-counter liens. And over-the-counter might be a good option for those that may not want to participate in a live sale. Something else to take note of is that I would say probably 95% of the tax lien sales, that are taking place are still conducted as live auctions. What that means is that in many counties, there's a tremendous opportunity with over-the-counter liens. And when counties like that hold sales and have a huge selection of over-the-counter liens, that's the perfect county, the perfect situation to work in over and over again. One thing to keep in mind to think of I guess to do is think about things you can duplicate. Think about ways to simplify the process and to make it easier. And reinvesting in the same county over and over again is certainly a way to simplify that process to make it easier. Maybe you attend a certain live sale every year. Tax sales are typically held once a year. So you know that if a tax sale is held at a certain time this year, it's going to be held roughly around the same time next year within a couple weeks. So it makes it a little bit easier to plan for that. And the idea is to get a handful of counties that you constantly, that you're always investing in. It makes it quite a bit easier and faster. So let's say you have 3 different counties that you invest in. It could mean that you constantly have liens that are redeeming, and every 3 to 4 months, you participate in a sale and you reinvest those funds. That's going to be the easiest way to participate and get involved long term, and also to avoid confusion. Because once you get familiar with state laws and how it works, once you get familiar with counties, there's nothing left in the process that's really unknown. And that, I think, is probably the biggest problem people have. And you also have the benefit, not only with over-the-counter liens, you're going to earn that maximum interest rate return because you're not competing with anybody if you buy it over the counter. So you're looking at liens that were offered at an auction, but for whatever reason didn't sell. It's fairly common, I think, for tax liens to not necessarily get a bid. It doesn't mean that they're all garbage. I think when you're dealing with tax deeds and homes, the nicer tax deeds are going to have a tendency to get picked up at auction. But that doesn't necessarily happen so much with tax liens. And the reason for that is because when you buy a lien, you're not actually buying or you're not taking possession of any kind of property. You're not actually buying property. It doesn't convey ownership rights. The other factor, though, is the elapsed time in the redemption period. That's something to keep in mind if you're buying over the counter. Is how much time has it been since the tax lien was initially offered? Because that can reduce the overall duration of the investment. Let's move on here, though. Okay, this is an important one. It's actually one that I was thinking about through most of the training while I was prepping for this. Limit your due diligence on tax liens. This is probably, I think, one of the bigger problems people have is when they're not really sure about what it is that well, I guess when they're doing something new like this, they want to cover all their bases and they want to make sure they're not making any mistakes. And with tax liens, I guess what we're saying here is you can take, I guess you can breathe a sigh of relief because you're not actually, tax liens don't convey any ownership rights. And at the same time, they also don't convey those same ownership concerns. So you're not buying the property. In fact, like I said earlier, the majority of the time, the due diligence you're doing won't even really matter because the lien is going to end up redeeming. And if it redeems, everybody walks away with what they want. In other words, as the investor, you get the interest rate return, property owner keeps their property. Nothing actually really happens. But if it does come down to foreclosing on a property, that's where your due diligence becomes important. So let's talk about exactly what's required and what's necessary, because the due diligence that you need to do for tax liens versus the due diligence you need to do for tax liens is really completely different. It's you're going to use some of the same methods, but the requirements for tax deeds are much higher because, well, first off, tax deeds typically cost more money. But second, when you buy a tax deed, you're just buying a foreclosure. So you're just buying a property. It's important to do your homework on the property so that when ownership is conveyed, you don't have any surprises. So what exactly would the requirements be for due diligence? I think I actually switched these around here. There are a couple of things that are really simple. First off, I guess, maybe I didn't, because this kind of plays into it. Land plus improvements equals security. Okay, if you want a very safe way to invest in tax liens, keep in mind that the biggest risk you're going to face is useless land. So if you want to avoid that, you can select properties that have land plus improvements. Improvements can be lots of things, but typically, if you have raw land, it has a greater chance of not having a loan against it. It has a greater chance of being owned by a single person. Uh, Everything about raw land increases the chances of foreclosure. Now, even then, that doesn't mean that all raw land is a bad investment on tax liens, because there are plenty of, you never know when a lien is going to redeem. But if you want to increase the chances of it redeeming, if you want to add security overall to the investment, then stick with land plus improvements when you're looking at properties. And that does fall right into what exactly the due diligence requirements are for tax liens. And here are a couple of things here to cover. Let's see. Sorry, sometimes I read questions there and I get lost in thought for a second here. The requirements, first off, we talked about land plus improvements. That's something that's pretty easy to identify on a tax lister with just a little bit of due diligence. The second is making sure that the bid to value ratio is okay. So we're saying less than 7% there, and that'd be a pretty fair rule. Oftentimes it'll be quite a bit lower than that. And then the third thing is making sure that it's a first-year lien. Now, outside of that, the reality of it is that it's a lot of those other things are not really going to matter. A lot of the things that you're worried about with a tax deed, like any kind of a title issue or possible liens that could be against the property or something like that. That stuff isn't really, they're not things you need to concern yourself with. I mean, if you see something that's out there and obvious, then you could choose to avoid it. But the majority of the time, tax liens redeem. So knowing that, we know that most of the time we're just going to end up getting a check rather than actually acquiring the property. However, if we do need to foreclose on a property, we want to make sure that the value is there. And if we stick with these things right here, then we're going to ensure all of those things. If we're sticking with land plus improvements and the bid to value ratio is right, then the amount of the lien that you purchase should be just a fraction of what the property's worth. It should be a great investment. Also, if you're sticking with something like land plus improvements, it's always going to have a lot of use to it. And the greater use that a property has, the more it's worth, the easier it is to sell. Really, it's just the opposite of what you find with useless land. You're looking for something that has a lot of use, that has value, that somebody wants to keep, because ultimately what you're depending on is that person's desire to keep their property. And the biggest risk really that you'll face as an investor is useless land. So another point here is that it's better to buy one lien, let's say for $1,000, than 3 liens for $300. And that falls right into some of the same reasoning that we had in that last point. You want to choose a property that has improvements, that has significant value. If you can choose something that has significant value, then you're never going to run into a situation where you have a lien that's not worth foreclosing on. That's really the greatest risk, is that somebody doesn't pay off their taxes and the redemption period comes to an end, and the property is so lousy that it's not even worth foreclosing on because you couldn't sell it. That's the risk, that you have to watch out for. So if you're sticking with land plus improvements and a bid to value ratio that works, then you're going to find properties that are worth foreclosing on always. And it really just kind of concludes here with keeping in mind that biggest risk being useless land. How do I know if a property is useless land? There are a number of things that you can check for. First off, the lower the lien amount, the more likely it is that it's going to be useless land. I guess a question to ask yourself is, am I looking at leftovers, from a development? When you make a pie, you've got your different cutouts, things that you're going to use. The stuff that's left over that you don't use from your cutouts, that's kind of the way land is when they do a development. all the little leftover pieces. They're going to try everything they can when they're developing property to fit in all the lots they can, but there's going to be lots of little leftover chunks and pieces. And oftentimes that's exactly what useless land is, the leftover pieces, because useless land isn't it's not a building lot. It's not, large parcels of land in rural areas. That's not useless land. Useless land is almost always, these small pieces that you can't really use for anything because either they're too small or because they have different easements on them. Maybe they're landlocked, so there's no direct access to it. They're between a bunch of different properties. Maybe they don't have a physical address. And
They're
with
also going to have a really low assessed value.
Yeah,
If it's on the list or if it's in the county record, when you look that property up, you're going to see that it's got a very low assessed value. Now, if it had an assessed value of $1,000 then or $2,000, then you probably know it's junk. But if it has an assessed value of $30,000 or $40,000, then you might look to see if it's a building lot within a neighborhood or something like that, because a property like that would have value. That's going to be the difference between a piece of useless land versus a piece of land that does have value and is worth buying.
yeah. And if you think about it, there's only a couple of things we really have there's only a couple bits of information that we need in order to determine that. To find out what the assessed value is from the county is pretty easy. A lot of times the counties will include that in the list, but if they don't include it in the list, then it's easy to pull up. And with useless land, the bid to value ratio is probably going to be all out of whack. It's probably going to be crazy because those properties just constantly get regurgitated through the system again and again. Somebody buys it and then realizes it's useless and stops paying the property taxes or never does pay the property taxes on it until the property is foreclosed on again, and then it comes up for sale again and was reoffered and sold to somebody else who does the same thing all over again. That's what happens with a lot of the useless land, if it does get purchased, period. But that's why you'll see a bid to value ratio that is just way too high, because they oftentimes are including many years worth of delinquent taxes. I've seen properties before that had like 20 years worth of delinquent taxes that were piled on, which is crazy. Most of the time they'll do some kind of a reset at some point.
Some counties in some states like Arizona and Colorado have started offering those at deed sales now, commissioner deed sales, just to get rid of them and start them at a real low bid and just get rid of those properties so that they can get somebody paying property taxes on them.
That actually brings up something kind of interesting, and that is the evolution that we're seeing right now, the way that the tax sales are evolving. Because prior to the internet, counties were always limited by their ability to get people out to the sale. And most of the advertising when you're talking about local newspapers, but really they didn't really have the ability to draw people out to their sale, because always going to be limited by travel, especially counties that are in locations that are not very accessible. So if they're hours away from an airport, they're in the middle of some area, if it takes a lot of driving to get there, a lot of those things are just going to prevent out-of-state investors from ever showing up. So, for a long time, they've had to rely on all their local investors, but now that they're able to do it online, they suddenly have more opportunity and more options. And we'll probably start seeing more things like this, where counties, like for instance, what Steve mentioned, how Arizona counties are foreclosing on properties and offering them at sales. We're seeing more and more counties that are picking up on just what a great tool the internet is becoming for them to sell things, and they're, I think, creating new opportunities. They're basically creating more opportunities for investors to buy. So let's see here. This really covers most of our tips here, but we're going to look at some live examples so that we can we're going to look at some other live examples here. Let me just look at a couple of questions here. It's a good question. James is asking a question about on the over-the-counter liens and about other people beating you on the properties. I guess I guess I'm not
I think I
totally.
might know a little bit about what James is talking about. James, I can't remember exactly what county he is, but he purchased some tax liens in Florida, and he bought them online. And this is actually a good point that we can mention to the students. He purchased them on one of the online auction sites, but the list probably didn't get updated daily. Maybe it gets updated weekly or whatever. So 2 of the tax liens that he had purchased had either already been purchased or the property owner had redeemed within the time the county had updated the online auction list.
Oh,
And
so
so they may do that like once a week or something like that. And so what I recommended to him, and this was this particular county because we haven't seen it in other counties, but that doesn't mean that it couldn't happen, especially if they don't update it, if it's not updated in real time.